Amy, you're trimming your U.S. exposure.
I am.
And looking around the world, particularly to one of the slowest growth countries in the world, Japan.
We did. Well, Japan, I do like Japan. I'd like Japan from a longer-term perspective. I think they're doing a lot of serious reforms that won't actually bear fruit in the very short term, but longer term, the companies are reducing their really large cash positions, increasing dividends, doing buybacks, just a lot of smart pro-shareholder-friendly policies.
How long can we wait to listen to Japan? I've been optimistic on Japan. Not anybody cares what I think, but yet it is because it's the cheapest developed market in the world by a lot.
Well, Japan,
by a lot in
right.
every metric, but the market doesn't care. It hasn't done anything.
Well, the market, it hasn't done anything, but also Japan has a lot of Japanese companies have a lot of leverage towards China. So China reflating and trying to stimulate their economy should help Japan. And it's very hard to predict when these reforms will actually be recognized by the market, but they're happening.
Earnings growth has been strong for Japanese companies.
Top-line revenue growth has actually been okay. They have a huge demographics issue, which they're grappling with slowly. You saw the article in the Times this weekend about women in the workforce.
Well, they're putting more women in, which is good. They need to do that. They've needed to do that for a long time.
Right, but as the article was talking about, they're putting women in the workforce, but most of them have part-time positions because they still have to do all the housework at home, and there's very traditional. So those will change slowly, but they're changing, and that's the good news. And it's relatively cheap, and I think the yen is going to go down further. And so I think that's all good. But one region that we're also looking at now is Europe. Remember, at this point last year, we were talking about a global synchronized recovery, and everything was doing so well. How much things can change in 12 months. But right now in Europe, you have actually fiscal policy going from contractionary to stimulative in regions that you never thought that would happen. I mean, Germany's had a surplus for the last 5 years. They've brought their debt to GDP ratios down. Now you're going to have a tax cut. Now you're going to have fiscal spending there. We've passed the emission standards. Retooling for the auto sector. Italy's bonds are, the yields are down 100 basis points, and you're finally seeing some lending in that region. Oil prices going down is a huge stimulant.
Yeah,
for
huge
Europe.
for them. At $8 a gallon, effective what they're paying.
But let me ask you this question. So you don't really have tech over there in Europe. You said you'd rather be in tech.
I'd rather be in growth, particularly in the U.S. in a slow.
Growth is synonymous with tech, in my view.
Right.
You also said you're at the end of the cycle.
Right.
Zuckerberg on line too.
Exactly.
Tim Cook. You also said that you're at the end of the cycle.
We're at the end of the cycle. I actually think we're at the end of the cycle here. Europe has a lot more slack in their economy than we do.
But Germany is an export economy primarily, and it's an export economy into industrials and into cars, and we've seen those fall by the wayside. Plus, you have a declining economy there. There are only so many levers left to pull. The only lever they left to pull, is that they can go and buy more bonds instead of selling.
The tax cut too, though.
They can do fiscal stimulus. They can give, which they will do. I mean,
but that's by each country. And each country's in such a deficit that it's, except for Germany, that's unlikely.
But you're still going to, you're going to get France. France is going to give a tax cut. Even Italy got permission from Brussels to overspend by the rules. So I think
they got pulled back.
I actually think you were going to see fiscal either neutral or stimulus in almost every country in Europe this year.
John, what do you think?
They're taking a page from our playbook.
I know you've been there. By the way, you've been there a lot lately. That's mostly on the ski slopes.
Yep.
But had you had a chance to mingle with the common folk at all?
Oh, you bet. And one of my favorite stocks for Europe would be Accor. This is a big hotelier.
Right, yeah.
And they're doing what companies are doing around the world as far as they are not building new hotels like Raffles and so forth. They're instead franchising them, Brian, and they're bringing people in that are operating those, and they're just taking the franchise fee, which is like, between 12 and 20%. That is just manna from heaven for a shareholder when you look at that company, AC. That's why I've been pushing some of our folks towards that name.
So one of the things about Europe, when it was doing well, like you said last year, it brought everybody up, right? And now it's brought everybody down.
Well, I could argue that that's China.
Right.
That's
Well,
actually the driver.
China too, but Europe too with Brexit, the uncertainty over there, the negative interest rates have not helped.
Right.
Right. But
well, they hadn't helped the banks.
Right.
Yeah.
And so the view we take is, look, if Europe gets healthy, then U.S. gets even healthier.
True.
Because our multinationals will do really well.
Right.
And then you get valuation back here, and you have a much more liquid, transparent market.
My problem with that is where we are each in our cycle. So I agree. Europe gets healthy. If we start to grow fast and we get, quote, quote, healthy, our Fed's going to be right back in. So, and I don't think the ECB or the BOJ has to be as aggressive as our Fed, just because of where we are. We're at the 4% unemployment level, and inflation is closer to taking off here than in other places.
We'll leave it on that.